everyone. So today we're going to be speaking on inducement and how we use inducement to identify valid, invalid pullbacks in the market. Okay. Okay. So we have a series of swing points. We have high, high, low, high here, high, low here, high, high, low. And of course, this would have been the higher low that we're looking at this point. So the breakup structures that we're having are going to be validated by where we particularly get, uh, you know, the breakup structure. And normally, sometimes we look at each swing point as a break. These would have been internal break points, right? These would have been internal break points here, but these are not valid when we're looking at the overall structure. So uh, the market pushed from this extreme low point to here. Take note of that. And maybe at this point, what happened was that they were maybe retailers were looking at the market as a downtrend, and they possibly, when it came here to this point in premium, based on the range from this high to this low, they would have been looking for sell opportunities to go lower, right? So what happened was, retailers on the lower time frame would have taken an opportunity for a sell here. And unfortunately, what happened, the buyers or institutional buyers would have stepped in and pushed against that, taking out their stop losses and giving us that break. We normally would call this area an area of early buyers, right? So, yeah. So this area where the market pushed from, giving us the external break or significant break of structure, the real break of structure, that is. This is what or where we call the trap because it's based on a perspective of the market at a particular time before this break being bearish. So sellers were possibly expecting continuation of that trend, right? Okay. They possibly were expecting sell from here and maybe a pullback in here for the continuation of that sell. So instead, what we got was a reversal, right? Now, this area of early buyers is the inducement or the trap. That is a trap. Some people would call this also a change of character or market structure shift, whatever you want to call it. But as you're looking at a bearish market, a bullish market, you want to keep the bias based on bullish references, right? The moment you start to use a change of character in a bullish trend, you're basically going to be complicating the confluence that you're trading. So as it is bullish, this area of early buyers would have been your area of inducement or your trap, right? And your area of demand would have been this specific zone that we're looking at here. All right. Similarly, we have a swing low here, which was validated immediately after this inducement was taken out and it tapped into the demand zone. It was validated. And we can see where the market pushed from this area up, failed to take out a high in one sweep, pull back, push, failed to take out that high again, and we see another pullback. And this is the actual pullback that actually gave us that break of structure right there, right? So that would in turn make this an area of early buyers. This would be an inducement, and this would be your area of demand, your potential area of demand. This would be a validated, significant valid swing low, right? or higher low, that is, right? So similarly, we have to let's flip the market a bit. Yeah. So if this was a bearish setup, this is exactly what it would look like. We would have uh, a buy distribution, right? A correctional push or pullback. We have a drop that failed to break this low, minor pullback. Then this pullback would have given us the breakup structure that we're looking for. And this would have been an area of early sellers, naturally, right? So what would validate the continuation of this bearish trend is when the market pulls back here, takes out this inducement in this area of demand, which also has some maybe equal highs would have been there, maybe a fair value gap that would be added confluence. That would be an area that we'll be looking for the market to go to, right? And remember, these points are the major points. So once a low is broken, we get a break of structure. And once the high is taken out, we get a change of character. So we'd be looking at where the main swing points are to know where we are going to get our breaks. We would not look at a high like this for a market structure shift. This would be the high we'd be looking at, right? Okay. Let me go back to where we was. Okay, now so we have this area. Market created a low, pushed, failed to take out the high, pull back. This was the low that actually took out the high, right? So that would basically make this the inducement. But unlike this area where it took out the high and came back immediately to take out the inducement, it took out the high, never came back, and instead gave us another break of structure at this area. That would in turn make this the significant inducement, and this would have been the significant area of demand. So as you see the swing point markers, these help us to identify where the significant structure is at all times. So we can know where to put our demand zone and where to look for the significant uh, liquidity that is needed to be taken in the market, right? And I hope this is a helpful video. If it was helpful, go ahead and give me a subscribe, go ahead and share, and definitely leave a comment on that video. All right. If you appreciate it and you want to see more content, definitely go ahead and support my page. Thank you very much.